Financial statements are a business's summary of their transactions that are recorded at a specific point in time. There are 3 financial statements that I will be focusing on today. 1. Statement of comprehensive income. 2. Statement of changes in equity. And 3. The statement of financial position. These statements must be completed in order. It's as easy as 1, 2, 3. First off, we'll look at the statement of comprehensive income, also known as the income statement. This is the reporting of a business's revenue and expenses, with the key component being revenues minus expenses equals net profit or net loss. I will be showing you a multi-step statement of comprehensive income. So we start with the sales revenue minus COGS equaling the gross profit, plus any other income including interest revenue, minus expenses equals operating profit or expenses before interest tax, minus interest expense equals earnings before tax. Then you minus the tax expense and you get the net profit or net sales of return. Once the net profit has been calculated, we move on to the next step, number 2, the statement of changes in equity. This is the reporting of the change of a business's retained earnings over a specific period of time. To calculate this, we use the retained earnings at the beginning of the period of time, plus or minus the net profit or loss calculated earlier, minus dividends, and that gives us the retained earnings at the closing balance. After calculating the retained earnings at the end of the time period, or the closing balance, we move on to the final step, number 3, the statement of financial position, or the balance sheet. This is the reporting of a business's assets, liabilities, and equity. Using the accounting equation, assets equals liabilities plus equity, accountants can ensure a business's financials are balanced. We begin with the current assets, for example cash, and the non-current assets, such as equipment or land, on the left-hand side column, and the current liabilities, for example accounts payable, non-current liabilities, such as mortgage, and equity, i.e. retained earnings, as calculated earlier, in the right-hand side column. The totals of each column should be equal, and if they're not, then you've got a problem. So there you go, the 3 most important financial statements used in recording a business's transactions, and it's easy as 1, 2, 3.